featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
Welcome to Your Money, Your Call. It's bonds versus equities. I'm Mark Todd from FIIG Securities. We've got a great show planned for tonight, and if you have any questions about the share or the bond market, please give us a call on 1300 30 34 35, or you can email us, and the email is yourmoney@skynews.com.au. And joining me on the panel tonight is Steve Lambert. He's the Executive General Manager for Debt Markets for the NAB, and Roger Montgomery from the Montgomery Fund. We tried to put them together a few weeks ago. There was a bit of a mix-up with the timing.
Yeah, sorry, it was all my fault.
It was clearly all your fault, but that's all right. We've got you finally here, so that's good. We can talk about the markets in general. And we had to bring Steve back because even though we spoke for an hour, there was so much more to talk about. So it was great.
It went really, really quickly.
Yeah, it was extraordinary.
Really I feel terrible that I left you in the lurch.
Oh no, we carried on pretty well. I thought we were entertaining. The ratings went through the roof. They thought, wow, those two guys are great.
The guys at work say that as well. It all goes better when I'm not there.
Exactly. So we'll look at these ratings next week. Going through the roof, market volatility. I just wonder whether the equity markets have been volatile again. We've been talking about the idea that it's the four majors and Telstra, but the Japanese movement in the QE forevers, there has been a lot more volatility in all markets. So I suppose if I can start with you, Roger, how do you manage volatility as a quantifiable piece for your customers? How do you manage that volatility?
Okay, so the first thing is to understand that the rest of the equity investment world sees volatility as risk, and we see it as opportunity.
Right.
So we want volatility because what it means is the very good companies that we buy shares in or try to buy shares in, if the more volatile the shares are, the more likely we can get them at a cheap price.
Yep.
Okay, the reality is that we'd like it to be volatile until we buy, and then after we've bought, we don't want the volatility anymore, right? That'd be ideal. But that never happens. And so what we try and do is we try and build a portfolio of companies that are in different industries that all have similar characteristics with respect to their economics.
Yep.
They're all very high return on equity businesses. They have little or no debt. They have bright prospects for their services or their products, and they have bright prospects for intrinsic value growth. And what we've discovered is that our portfolio, and we'll see this later on when we look at the performance of the funds, the performance of our fund is less volatile than the overall market. It does better when the market goes down. It seems to do better when the market goes up as well, so far. What we're noticing though, and with respect to the switch from term deposits and cash and bonds into equities, you mentioned the four stocks, basically the four majors, four banks or three banks and Telstra, with the exception of NAB, not so much NAB. I think that's now spreading, and we're seeing interest in stocks. And we look at the biggest companies we've got in our portfolio: FIIG, the Reject Shop, Cochlear and CSL. We've just bought Cochlear just the other day when the price plunged. What we've noticed is there is interest and there's increasing volume in those stocks as well. So it's moved beyond just the high dividend yielding stocks.
Before I move on to Steve about that, in terms of the volatility, do you advertise that fact to your potential investors, the fact that it's not as volatile? In other words, you haven't seen it.
Look, so we aim for it. But the reality is in our industry there are people making all kinds of promises. We can't tell you what the performance of the fund is going to be in the short run. And volatility is really a short run phenomena. It's not something we care about over 10 years plus. When we look in 10 years time, when we look back over the fund, all we care about is that you started here and we're up here. Right? And our clients, when they look back 10 years, they're just going to care about how much they've got compared to how much they started with. They're not going to care about the volatility so much in the short run. So we try and see it as an opportunity. We don't advertise that it's less volatile. It just has been.
And I don't know about you, how does the volatility affect the debt capital markets for you? What happens to your client base?
What, the equity volatility or generally?
Just general. I think equity volatility is the one that drives a lot of the conversations. We have so many people, regardless, they don't like it. It's too much for them, and so that's therefore the driver of the bond market. And we can show that that's consistent. In terms of...
I think there's a few things. I mean, we also have a comment, we talk in the debt markets around, we like volatility, but we like the right sort of volatility, right?
The volatility that goes up.
Like the right volatility at the right time.
Yeah.
Equity volatility is interesting because I guess some of the key drivers, ultimately equity markets and the real economy, are the same across equity and debt. So things like inflation, things like inflationary expectation, levels of rates, interest rates, etc., general levels of economic activity, pretty similar. And historically, sometimes the equity markets and the debt markets are reasonably linked. I mean, they'll both take certain same views around asset prices with inflation, things like that. But I would also say that there is a lot of noise in the equity markets. There's a lot of noise around company valuations and views around individual stocks that you're probably not seeing you don't see as much in the debt markets. Debt markets are generally less volatile, and you see that historically.
With that volatility and you being part of a hybrid issuance, do you find that it becomes much easier for the salespeople to sell the hybrid in highly volatile times? That you say, look, this is the easier option. I'm going to give you a coupon. It's nice and consistent. Do you see people picking it up, or do you just think hybrids basically from the NAB, everyone wants to buy them regardless?
Yeah, I'm not sure that we've seen that sort of correlation between the different market tenors. I think it's generally this. I think there is definitely something that how investors view volatility generally these days, and we talked about sequencing risk the last time we were on, around the views around how does volatility affect someone at different stages of their own life cycle and as they're moving into a pre-retirement phase, and we definitely think that equity volatility has actually been part of the reason for a switch into more stable style of instruments.
Yeah, I think that's an absolute certainty.
And just on the volatility point, there has been more of it lately. There's no doubt about that. I think we made 3% or 4% this week. For our investors. Now that's just not normal.
And that's good and bad. It's great to make it.
Well, it's great to make it, but
hang on,
the next week it could be down.
Yeah, that's right.
So. There's more of it. Some people who look, I'm not a chartist, I'm not a technical analyst. I don't condone it. I don't suggest people should apply it. That's only for professionals who want to lose money. But they tell me that increased volatility tends to happen around turning points in markets. I hope that's right, because we've got plenty of cash still to invest.
Lots of cash. Speaking of investing cash, bank funding. How would you characterise it right now? Because I know that part of the narrative for all the CEOs of the banks has been able to explain bank funding, and I think it would be fair to say Gail Kelly stated they haven't done a good job. I don't mean all the banks, but she certainly said with Westpac they didn't do a good job. I guess the guys at the CBA, when they lifted rates, he retired, so he doesn't care. How is bank funding in general at the moment? What is the movement? Getting easier? Still tough?
No, I would say that over the last year, as general level of economic activity is sort of relatively stable. It's not really growing very strongly. The demand for banks to keep raising wholesale funds hasn't been there. They've either been able to raise funds quite comfortably through their deposit growth.
And it's been phenomenal growth in deposit funding.
Ever since the last, say, 3 or 4 years, the banks have all concentrated on those ratios a lot more. And at this point, they're funding very comfortably the levels of growth that we are seeing through the balance sheet. So I guess the real question is what will happen if economic activity really starts to pick up? Will that deposit funding still be there, or be there at the right price, or do the banks then need to start using wholesale markets?
Because the flip side has been there's been very little credit growth.
No, that's what I'm saying. That's what I'm really saying.
Very little credit growth, and so people aren't spending the money. So they're putting it in the bank. They haven't been putting it in equity markets. So this PE expansion's you surprised everybody. But if we get continued earnings growth, then what you'll see is more money going into the equity market, and maybe that growth in deposits will actually start to slow.
I think the key is actually on the other side, I think, and it goes to your point. Credit growth hasn't been there, and because of that, the banks have not had to go out and try to raise more funds to basically fund that growth in credit.
And do you feel it's part of the reason is because the consumer has become more conservative? The lessons for the GFC has meant that people pay off a lot more debt, they don't spend as much money, they are naturally more conservative.
Don't worry, by 2016 that'll all be reversed again.
Well,
it'll all be changed.
The consumer has a certain
they'll be borrowing against their house to buy their BMW X5s.
That's right, they don't go forever. But it's a good point about that credit growth, and also there's structural problems with the credit growth, isn't it? In terms of the Basel III, who you can lend to, how you can lend people money, and that's very hard for an investor and the person wanting to borrow the money to struggle. They really struggle to come to grips with that.
Yeah, well, I think this goes to the point around, we talked about last time around education. I think there's a lot of education, not just around bond markets, around products and what they are and how to use them, but generally some of the broader dynamics happening in the broader market.
Let's talk about the broader economy after the break. We have to go to a short break, but please give us a call on 1300 30 34 35 or any questions you might have via email. The email is yourmoney@skynews.com.au, and we'll be right back. Welcome back to Your Money, Your Call. My name is Mark Todd, and tonight I'm joined by Steve Lambert, the Executive General Manager of Debt Markets at the NAB, and Roger Montgomery from the Montgomery Fund. And they're here to answer any of your questions and any phone calls. Please email us if you have one at yourmoney@skynews.com.au. And we have our first caller for the night, and it's Eric from Sydney. Hello, Eric. How are you?
Good, thank you. Look, the question I have, Mark, is I've seen quite a few of the guys from FIIG Securities pushing the Sydney Airport bond. I'd like to ask Roger, I mean, I've seen him on several programs on Your Money, Your Call. He rates the Sydney Airport basically a C5. I may be wrong, I may be right. I'd just like to ask Roger, basically, if he could go through the financials of Sydney Airport to see whether maybe it is a good investment. Thank you.
Okay, well, I'll tell you what I can say, and it's this. I can't go through the financials because I don't have them in front of me, but what I can tell you is that the return you're going to get from the equities is never going to be as high as the return you're going to get from businesses that aren't considered infrastructure type investments. And the reason why that's the case is because the natural owners of these long-term assets, even the equities of these long-term assets, tends to be, for example, pension funds, long-term pension funds. And so the result is that you get occasional blips in the share price, but typically they only want to get inflation type returns plus 1 or 2%. And if they can get that, they're happy with that. So they put these stocks on very low internal rates of return, naturally pushing the share price up. So it never gets to anywhere as cheap as what we would like. Based on the cash, on the interest cover, this is not a business that's going to go broke, but we find if we own this type of stock, it would detract from the returns we're trying to generate on our funds.
And like all those things, people get a little bit confused about different asset classes and trying to put them together and making them blended. One's a debt product and one's an asset that's an equity piece, and they have different characteristics in your own portfolio. So the reason why we like Sydney Airport is because of what you've just described, whereas they have an inflation-linked bond where you'd get, let's say it's around about 4% plus inflation. Inflation is between 2 and 3. At 6.5% for an infrastructure trade, that's a good trade. But at the same time, we'll go and talk about different equities you can go and buy to marry with that. But I think everyone should have some inflation-linked assets.
But what's interesting is that as an equity investor, you rank behind the bond holders.
Yeah.
And yet often the share price is pushed up by these pension funds to an internal rate of return that is less than the bond.
That's
right. Doesn't make sense.
That doesn't make sense. So buy the bond. I mean, that makes sense.
And I think equity, the infrastructure generally has been such a hot area for the last couple of years amongst global instos.
That's right. And if you can get something that's a hot at north of 6, all of a sudden you're a smart investor in that asset class.
And the interesting thing for Eric, and I'm sure he's still listening to what we're talking about. But the interesting thing is, if you look at the cash flow of that business, it's significantly better than its reported profits, because what tends to happen is there's a massive depreciation charge in these infrastructure companies, and that depreciation reduces the profit, but their actual capex, the maintenance capex, is significantly lower. So that's why the cash flow is so much better.
That's right. That's what you want to see. We have another caller. We have a caller, Duncan from the Gold Coast. Hello, Duncan. You want to talk about credit growth?
G'day, gents. How are you?
Good.
Well, thanks.
Yeah, g'day.
I just, you were talking about credit growth before. I was just wondering, say, 30 years ago, what was the percentage of lending that, say, your major lenders in regards to commercial compared to housing? What would be the ratio today with housing to commercial today? Would there be more housing loans out there compared to commercial? And then if interest rates go up or down, does that really get businesses very excited these days?
Ooh, well, that's probably should be for me, but I'm going to have to come back to you on that one. I think
broadly thinking, but I would imagine that in a macro sense, it's harder to get funding for commercial properties unless you are the big guy in the street. So if you've got a $4 million commercial property and you say, look, I've got a great idea, I'm going to make this into something else, going to any bank, it is definitely harder. That's just life. I mean, they can't give the level of gearing that they could give just because the politicians, the too big to fail, the moral suasion says that we want you to be much more conservative naturally. So I'm guessing it's harder.
I haven't looked at credit growth 30 years ago. I was only 30 years ago, I was 12.
13.
I was 12.
Right.
And so sadly, I don't know. But that doesn't mean I shouldn't look back and have a look. But what I can tell you is when we look at the bank profits, only a very small proportion of that represents credit growth. You know, a small portion of the profit increase that banks are reporting over the last 12 to 24 months has been credit growth. Very, very minor.
Yeah, well, we talked about this last week, didn't we?
Yeah, what I would say, definitely in post-GFC, in the last, say, since 2008, what we have seen, particularly in commercial property, is a greater aggregation amongst the four majors. Now, I think there's been a few factors there. I think one factor has been some significant foreign lenders, albeit perhaps relatively large overseas, of relatively small size domestically, but were very active in the developer space, as well as some of the regional banks that were also very active in that space and no longer as active. They've either pulled out completely or scaled back. And also there's probably been another story amongst the mortgage funds, which are no longer as active as they were again in the developer space.
And when you think about the Lloyds, every time you read about Lloyds, and the guys at Lloyds are nice guys, but they were giving this complete basket case, and each time it's slowly but surely getting it off, and it was just all about the commercial property, wasn't it? They just lent so much money to it.
And what's interesting is you have booms and busts in both. And 30 years ago, if you wanted to borrow money to buy a house, you had to go hat in hand, to the bank and beg, basically. And these days, you put one of those.
They still want you to beg. No, but that's true.
But you put a note up on a power pole, at the lights, and you'll have 55 RAV4s and all these cars with all the promotion on the side, asking you how much you want and telling you we can lend you more, and that's still the case.
I suppose. Let's shift a little bit, Roger, because I want to get your thoughts on resources stocks.
Sure.
I want to move around and understand that, because at the moment it's going so quickly. The idea that resources stocks are starting to perform better, or they were the ones that are drag on the market, and I saw some stuff coming through today saying they've really done a lot better. I think it's from a very low base. Why are they dragging the market? Why are they performing the way they are? What's your general sense of resources stocks?
So we a year ago, in April 2012. We sold all of our mining services exposure. We had no mining services stocks after that. And in fact, they rallied towards the end of last year and early part of this year, and we decided not to participate in that. We didn't buy them, even though they looked cheap. And what's actually happening is a big story, and it's not over yet. In fact, on my blog, I put up a video of the Carpenters singing "We've Only Just Begun," and it's a great song. And there's a
great song.
Yeah, it's a great song. But we only have begun. And what's actually happening is that China's demand for our materials, at best, is going to maintain steady state, in my belief, and at worst, it could fall off a cliff. And the reason why that's happening is because global growth hasn't emerged. It's not as strong. And what we saw is the iron ore price in Australia, but for 30 years before 2004, it traded between $10 and $20 a tonne. Okay, so this is just background. And then between 2004 and 2011, the iron ore price jumped from $20 a tonne to $187 a tonne. The response from Australian miners, massive. Dig it out of the ground as fast as you can, get as many cranes as you can, get as many people as you can, put them in the hole and dig this stuff out and sell it. And that supply response means that those mines, those projects that did commence, when that actually hits, we're going to have 2 Pilbaras of extra iron ore from next year onwards. And at the same time that China's saying, well, we've built enough buildings that no one wants, we've built enough roads no one drives on, we've built enough schools where there are no students, and we don't need that much iron ore anymore. anymore. What we want to do is transition our economy from a fixed asset investment to consumption-driven economy. That means they'll still demand some iron ore, but nowhere near the rate of growth that we saw previously. So there'll be a massive supply response at the same time there's a reduction in demand from China, and we're going to see massive layoffs in this sector.
I couldn't agree more. We have to go to another short break, but please give us a call on 1300 30 34 35 for any questions you might have on the bond market or the equity market, or you can email us yourmoney@skynews.com.au. We'll be right back to talk about the miners. Welcome back to Your Money, Your Call. I'm Mark Todd from FIIG Securities. With me is Roger Montgomery from Montgomery Invest, Montgomery Fund, I beg your pardon, and Steve Lambert, who's the Executive General Manager at the NAB. And before we went to the break, we were talking about the mining sector. So let's go back to your take on that sector, Steve. Well, what do you think?
I really like what Roger was saying. I mean, the reality has been that the last few years, the last 3 or 4 years, it's a rate of growth story, right? The rate of growth, mining investment has been the biggest individual sector driving domestic capex and domestic investment. And I think what the RBA has flagged and what we've seen in the press recently is just this: what sector is going to take over as this sector fails to grow at the same rate. So it's not a question of the sector not at the level not being there. It's a rate of growth story.
Yeah, and what we talked about in the break, and for the benefit of the viewers, we'll talk about the RBA.
Yep.
You know, they've got a big problem. You know, they're stuck between a rock and a hard place. They know that the capex has dropped off a cliff.
Yep.
They also know that if that continues and the iron ore price starts to drop as well, Chinese investment into the resource sector into Australia, well, there'll be no appetite for that. Foreign exchange reserve growth in China has gone to zero. The last time it went to zero was just before the GFC, and the time before that was just before the internet bubble burst. And so FX reserve growth has dropped. And why? Because the US isn't demanding as much from China, and they're seeing that. Europe's a basket case. Right? And it looks like that these quantitative easings aren't getting it going. You know, they're not getting it going. And so China's not building up the growth in foreign reserves, which it can then deploy to go and buy foreign bonds and stimulate the economy. So the whole engine of growth, and we're reliant on that in Australia, has just disappeared.
I think one of the things that for the viewers at home, they should know that the RBA is very careful with its language, and so when it constantly says we're accommodative, that's their code for saying we're worried. I feel, in my mind, in that they make the link. The mining sector needs another sector to take over because the mining sector will ultimately soften. And they look to this and say we'll be accommodative, because they're literally saying there's somebody has to take on. Who will take on? I feel they think it's the construction sector, but they need to see that. They need to see evidence, because this is a very fine game they're playing.
I think that's right. I think what I would say, and we also talked in the break around bank lending into the mining companies. I would say right at the moment, the quality of the projects you're seeing coming into the debt markets are actually of a very good standard. Because what happens when there is a lot of froth and there's a lot of enthusiasm, you're taking a more marginal.
But I'd be interested to know is in their projections, when they show the banks their budgets for these projects, what prices are they factoring in for the commodities? Are they forecasting a decline in the iron ore price in their budgeting, or current price?
Well, it just depends. I mean, I can't talk about individual transactions, but I mean, typically banks will scenarios. So you look at it's a range. You test deals around not just one assumption of a price. So you
attribute probabilities.
Oh, absolutely.
And what's interesting is when you look at all the experts, you know, the experts. And the analysis that we get, all this research that we get, you know, they tell you that the iron ore price $140 a tonne now, 120 next year, 115 the year after, 100 the year after that. And
it's very sensible.
When in the history of commodities have they ever just gone nice and smoothly down like that in a nice, budgetable, predictable way? They never do.
It's like every market, isn't it?
Yeah, exactly.
They always got to market it as if it's in a bubble, and there'll be no fear, there'll be no greed, there'll be no nothing. It'll be all very
I'm very worried about a big drop in the iron ore price over the next 6 to 12 months.
Which brings me to my next question. It must be hard to trade equities. I mean, it's in that environment because of the uncertainty.
No, it's easy. Just don't buy the companies exposed to that.
Okay, so how's the portfolio portfolio performing?
Well, we're fortunate that we've done very, very well, and I think we've got a chart.
I hope we've got a chart
here.
that'll come up.
The chart comes up soon.
There's the chart of your performance, and I think,
very good.
Roger, is it fair to say you're the guy on the top?
We're the guy at the top, and it's been going very, very well. And we talked earlier about volatility, and you'll notice the Montgomery Private Fund's performance is actually less volatile than the market, which is underneath. And we've achieved that by, since April last year, not being in any resources or mining services and owning businesses where they're reporting very significant growth in profits.
We're going to talk about one of those in a second.
We are going to talk about one of those.
The thing that I'm curious, what sort of numbers are we looking at there, Roger? What sort of return is it that you're getting, and compared to the broader index?
So for the Montgomery Private Fund, in the 2 years to March, we've returned over 35% in that time, and the market's generated about a 10% return in that time, or a 9% return in that time. So we're outperforming by a very significant margin.
And what's the feedback like? How do you get that out to the broader market to talk about that story, other than talking to me? Because everyone watches me.
That's about it.
I'm clearly, a lot of people follow me. But
the private fund only opens occasionally. It's actually been closed for about 8-9 months. And now we believe that there are going to be some opportunities in the market, and so we've just reopened the private fund again, the Montgomery Private Fund, and so we've got a lot of inquiry. People wait for an opening, and we send them an email to let them know that the fund's opened again, and they join at that time. So
one of the things I wanted to bring up and talk about was one of the assets that you own, which is Silverchef.
Sure.
So
great business.
Yeah, it's a great business. It is, and the reason why I know it's a great business is because we at FIIG did their first ever bond issue. They did a 6-year bond issue, and it produced an 8.25% return. Now, one of the things that Silverchef were looking to achieve, and I'm going to show a chart that I think underlines the achievement, the success, was if we can go back to the equity price of Silverchef, we can show you that at the very bottom, this is a Bloomberg chart, so not the Silverchef progression, that's the one. If you look there in the first large bar, at the bottom line it says 9.12. That was when we announced the fixed income offering. And what that did was, when we talked to our investors, a lot of them said, I've been watching this share, I've been looking at this company.
Well, we saw you do the bonds, we bought the stock.
Yeah, and that's what happened. It clearly was a great thing for the company, because they were able to access a whole range of different investors who were able to understand a bit more about the business. You were able to roadshow those clients, and they were able to get out. How many companies would be trying to get out on and getting a message out? There are thousands of them. And the Fin Review didn't really want to look at everyone, but being the first people to stimulate the corporate bond market meant they got a lot more press. And you can see the effect on the equity price. And if you can show the bond, I want to show you the performance of the bond, which gives me the theme that you buy both. Roger, I know you only buy one, but we buy both.
Well, our mandate only lets us buy one.
We can change that mandate soon, I'm sure.
I think we need to put
Jay, if you could bring up the other one, that would show the performance of Silverchef.
This happens a lot, I guess, generally in bond markets. It's not unusual that someone that may have been a domestic issuer predominantly then enters another market to try to get their name known in that market.
Yes, it's a very important part of a natural business. If your business needs to change, or the investor base, to expand and tell your story, if you've got a good story. Now that bond, that performance there since September is, if you include the coupon at 8.25, that's just a little bit over a 19% return over the period. And
that's a good result.
This is a very dull bond market.
Not as good as our equity result.
No, clearly, but
doubled our money there.
Again, they don't always have you there. So there could have been a person who's looking for the education themselves saying, I like that, I'll buy both. And they would have done quite well with their $50,000 or $100,000 investment in both. And
it's a great story. Yeah, it's a great story. We should explain to people what the company does.
Would you care to do that?
Yeah, they provide funding. They provide funding for restaurants and cafes to buy the equipment to set up. They have two businesses. They have the Silverchef business, which does that, and then they have what's called the Go-Getter business, and the Go-Getter business is a bit more competitors, a bit more competition, but they basically provide financing for other equipment, other business equipment. Now you might think, gee, that's very dodgy, that cafes are going out of business all the time. Well, in actual fact, if you look at the American Express statistics and the Visa statistics, what you find is that since the GFC, restaurants and cafes have been booming. They're the one sector that has done absolutely brilliantly.
Absolutely. It's a $3 coffee.
And what they do is they basically offer financing, so you can either rent the equipment then buy it at the end, or you can go into a finance package and then you can transition after 12 months to rent the equipment, or you can buy it then. You can do a whole bunch of things. But only one of every 10 gets handed back, and then they have to go and sell it. And they sell 80%. They sell 80% all of the stuff that's returned. They sell it within 3 months.
Yeah, they clean it up, fix it up,
and sell it.
And they have a lovely way of describing it. They call it rent, try, buy.
Yeah.
And that's a great way. That makes sense as a sales pitch to a person. You know, rent it, try it, buy it.
Can I give you some statistics on this?
No, because you have to go to a break.
Okay.
You have to go to another short break. We'll be very quick here. On the phone number is 1300 30 34 35, or the email, as you know, is yourmoney@skynews.com.au, and we'll be right back. Welcome back. If you have any questions at all about the share of the bond market, please pick up the phone and give us a call on 1300 30 34 35, and you can email us. The email is yourmoney@skynews.com.au. Before we went to the break, we had a Silver Chef experience, and you've got a couple of points.
It's a small company. It's only the largest holdings that we have when we initiate a position in the fund, the largest holding would be about 7.5%. This is about a 2.5% position for us. But to give you some idea, the hospitality rental income has grown from 2007. It was $29 million. It's now $95 million of revenue. And then in 2008, the Go Getter business started with about $2 million of revenue. It's now $65 million of revenue since 2007.
Yeah.
So it's just phenomenal growth. It's a small company. A lot of people haven't heard of it, but it's been going very, very well. It's a great little business.
You are preaching to the converted. Okay. We have an email from Tom. Let's go to the email. It says, based on current earnings forecasts, the Australian equity market looks overvalued at the moment. I'm finding very few stocks that are good value. I beg your pardon. That are good value. How do you approach the equity market at the moment? Hold cash, wait for a pullback, or upward earnings revisions, or keep gradually improving, putting money in? Thanks, from Tom.
Okay, well, it's an easy one. Everyone's out there, we know this, everyone is out there with cash in the bank waiting for a pullback.
Yep.
And typically, out of experience, what I know is that when everybody's waiting for a pullback to put money in, it doesn't happen. It doesn't happen because what they do is no one's holding everyone back saying wait. You know,
the equity guys always say that. They always say get in. They rarely say don't do it.
Oh, we're 25, but I should say we're 25% cash.
Right.
Now that's happened. That cash has grown because we've deployed a bit of it recently. But the cash has grown because when we look for value, we can't find any, and when we sell stocks that have gone way above their intrinsic values and we sell them, that gives us cash and we can't redeploy it. So this is the point that Tom's making. You know, what do you do? He's not finding value, we're not finding a lot of value. So what we're doing now is we reckon that come reporting season, which will happen in July and August, come reporting season, we think there'll be some companies that will surprise the market on the upside, and value will emerge again, and that'll be your opportunity to get in again. But if we get a sell-off between now and then, well, I hope we do, because we've got all this cash to deploy, then there might be another opportunity.
So Roger, I was looking at something a couple of days ago and I looked at PE. PE ratios, and everything seems to be that 13 to 15 type range, which I guess in my mind that's about long-term average, okay?
Yeah.
And so, whilst there's been a lot of discussion around the outright level of the indexes, particularly offshore, about it's reached highs again. But you looked at the PEs; they're basically long-term trend.
Yeah, the only problem with that analysis, and everyone does it, and the only problem with it is that they're talking about the market overall, and in that market you've got some rubbish businesses. You know, you've got big businesses that haven't gone anywhere in 10 years. Their profits are less today than they were 10 years ago. Now they deserve to be on a lower PE than that, and there are other companies that are on that PE that deserve to be on a much higher PE. So you can still find value when the average is at the long-term average, if you know what I mean. But it's not a game of averages. We're investing in individual businesses. So So it's really important that you find good businesses that are cheap, but at the moment they're not.
I would make, and I would agree with everything you've said, because I think it's very hard to find good value in the market at the moment, even around this volatility sector where you can say, look, it's a bit lower, I might get in. But the thing
Cochlear is an example of where there's some value.
That's right. I was thinking about Cochlear myself. But the thing that's clear to me is, or it's, I feel it's right, I could be completely wrong, it's the QE forever. I think the movement by the Japanese to say that we're at 70 billion and then the US at 50 billion means it's all bets are off, because the way they're approaching those markets at the moment is they are just flooding it with cash. And I find that very hard to come to grips with, to work out what's good value at all.
Okay.
Yeah,
so the important thing...
It's a valid point. Because at the end of the day, just saying, when
it's not a normal market.
When govie bonds are so low.
So low.
They're so low. And it's basically, it's why would you have money almost in the bonds? I mean, it's really almost rational.
So for the viewers at home, when Steve's talking govie bonds, he's talking sovereign bonds, he's Australian government, he's talking about the states of New South Wales, all the states have issued bonds, and these are very popular with offshore investors. Predominantly that's who buys the bonds. So they've bought all those bonds, and the corporate bonds trade relative to that. So if that market moves down, corporates will move down. Now they didn't move down as far, so there might be some opportunities around those, but that's starting to move down. We were talking, Nike issued a 30-year bond at 1%, a little bit over 1%.
Fantastic.
Over the swap rate. Nike, it was 30-year bond.
When you've got a AAA rating and interest rates are low, you should use your AAA rating and borrow money. That's what you should do. The government, for example, should be borrowing money. Why have a AAA rating when you're not even going to use it when interest rates are at historic lows? It just doesn't make any sense. And there's a huge appetite amongst our clients, baby boomers typically, there's a huge appetite for secure income. And that's what they want. And so you've got appetite for it, you've got the government needing to spend on infrastructure, and yet they're saying, oh no, we want to protect our AAA rating.
And that's something I want to talk to you about, Steve, after the break, because I think it's right around that idea of infrastructure, pension funds, who's the natural buyer of a lot of this debt, whether it just be a component of somebody's superannuation. But the government, it finds it very hard to win political agreement. So let's talk about that after the break. We'll have to go to a break. We'll be straight back after this latest ad. We've got lots of them because we're very popular. So we'll leave it there. We'll talk to you soon. Welcome back to Your Money, Your Call. It's bonds versus equities. My name's Mark Todd from FIIG Securities, and on the panel tonight we have Roger Montgomery from the Montgomery Fund and Steve Lambert, Executive General Manager for debt markets at the NAB. If you have any questions, please pick up the phone, call us on 1300 30 34 35, and the email is yourmoney@skynews.com.au. We were talking about the QE experience. About it's hard for the viewers at home. It's 70 billion from one country, it's 50 billion from another country. That's just two countries. That doesn't include Europe. It's unbelievable. And it's just a weight of money.
There's two things that you need to understand. One is that your traditional supply-demand doesn't work. The supply-demand analysis that we all learnt in first-year uni. That doesn't matter at the moment. The other thing to remember is everyone's focused on the United States, but foreign reserves, US foreign reserves, amount to 10% of global supply. For China, it's 45%. So the United States is tiny compared to China. It's China that's going to influence Australia and what they do with their money, not the United States. And so I just think you need to keep that in mind. We're watching China. We're watching the impact of this slowing growth in foreign exchange reserves over there, and what the impact of that will be on the Australian current account, on the balance of payments rather.
What I was going to say was that the point around QE for viewers at home, QE or quantitative easing, quite different from historically the way central banks intervene in bond markets. Typically they intervene through what they call open market operations, effectively looking to make changes in short-term interest rates as well as buying and selling government bonds. QE is actually a larger outright purchases of long-term debt securities, typically government bonds, but a whole range of different securities, and the view is that then they're basically growing the money supply. The real question, or really the thing to think through, and I think it's a difficult thing to get a handle on, is what is the transmission mechanism between that process and what's happening in the real economy? Because the theory would be, if the government goes out and buys a few $1 billion of say bonds owned currently by a major trading bank, that the major trading bank would take that extra cash they've now got and then lend it out.
They're not lending
but it's not happening. And, and you're really seeing this in Europe. You're seeing that in the US? Time in the States and also Japan. So I worry around, and the net impact of all this is it is risk on, and this is why I think the issue around the pullback, or you won't see a big pullback necessarily in ratios in the equity markets, because it is all about risk on. I mean, the government.
That's why I think you need reporting season to come out and profits to go up.
And why won't they? Why are they not lending? The banks. Is it because they want to repair their own balance sheet? Do you feel it's that, particularly in Europe?
Well, I think the interesting thing is we talk about banks, and we sit here in Australia, and probably the Canadians in the same boat. All the Australian majors went through the last 4 or 5 years in a great state. The state of Australian banking is excellent. Like globally, the Aussie banks not just maintained their ratings, but actually sort of like moved up the global rankings, if you like, as other banks fell. Offshore, the story is about repairing balance sheets, and also, you know, if you're a European bank sitting in the middle of Europe, you know, you're not looking at a lot of great opportunities available around you, even to support your customer base, because economic activity is so slow. And the Europeans are starting to move back into Asia again.
The thing that was interesting for me was the way Bernanke approached the same problems that you've got. The banks weren't lending the money, so he said, "I'll know what I'll do," and he bought mortgages, and that drove that mortgage market lower and stimulated that construction piece. And I thought that will be his legacy if he gets it right, and clearly. His problem is how to unwind that.
So the reason they gave it to the banks is because of the multiplier effect.
Correct.
Right? They wanted to generate credit.
Underestimated.
Because a lot of people said, well, why didn't they just give all these trillions of dollars to people? Just hand them the money, you know. But you wouldn't get that multiplier effect. Well, you haven't got it anyway. So they
underestimated the multiplier effect entirely. They just in the form of austerity, where they said, right. The Germans said, right, let's cut all the costs and we've saved X amount of billion. And what it did was crushed economic performance. And they said the multiplier effect was wrong. We've got the wrong number. And then the opposite, in lending money, it just didn't work. So then that comes back to the next question is inflation. What's your thoughts?
Well, so my view is, at the end of the day, the reason QE is happening is that standard open market operations are not going to work. It's a classic sort of, if you call it the Keynesian liquidity trap or whatever, however you want to think about it. Personally, I know the theory would suggest a lot of money out there, inflation should start rearing its head, but I think we're a long way away from that.
I think the fear over the last few months has actually been the opposite. Look at the gold price fall. The big fall in the gold price, big fall in commodities, with the exception of iron ore at the moment, and interest rates in the UK and in elsewhere in Europe and in Japan and the United States. It's all telling you the fear is deflation, not inflation. You know, everyone's concerned about the opposite. They're concerned about deflation. QE is not working.
It's definitely not working, and so then I would ask, the next point is, when Bernanke said to the politicians, you know, don't pass this fiscal drag that you did, and they passed it through, he's right. That sequester effect in the US is really quite significant. It's a slow leak out of the balloon, I feel. I mean, I think we all thought that the US is going to drive forward, but now what do you think of the US?
Well, I think a slow week is right. I'm still fundamentally pretty positive on the States in terms of its underlying. But yeah, we all talk. I think we talked last time around the impact. 0.5%, 0.75% it was probably going to have on GDP this year, which is really unnecessary. I mean, it came at such a bad time as well.
What's interesting for investors is to realise that the US has been muddling along at ridiculously low rates of economic growth, if any at all. 1%. We're talking about 1-2%. No economic growth to speak of, really. And yet the share market, better than Europe, but in that time the share market has gone absolutely bananas.
Crazy. It is that.
And so you get economists on TV shows like this and they say, oh, GDP is going to be X and, da-da-da. And it really has very little bearing. It all depends on valuations and individual company profits.
We have another caller. We have David from Sydney. Hello, David. How can we help you?
Oh, hi, Mark. A very simple one. How do the guys and you think QE is all going to end and unwind?
Yeah, that's the $60 question. Like, how do you unwind this thing?
Well, they'll keep doing it until they see that the economy can stand on its own feet. by then they'll have to very, very quickly ratchet up interest rates to slow the economy down to prevent inflation. So, you know, they're going to have to pull all that money back out at some point. Now, they're all saying, all the official statements are that won't be a problem. We'll have no trouble getting that back.
They would say that, wouldn't they?
But that's, yeah, you never ask a hairdresser whether you need a haircut.
Yeah, and turkeys never vote for Christmas, right?
Yeah.
Yeah, for me, I'm not sure how it's going to ultimately unwind. I think the balancing act in my mind is around, at one level, you want QE to have an impact on people's expectations and people's actions. You know, that's the driver. And an element of that is people want to put risk on. Because, you know, you can't get a return on instruments that are considered safe because they're so low. Rates are, absolute yields are so low, people will take on risk. So the point is, I think, and is really key, is people really have to think around what risk are they putting on. Don't just do things to get that headline yield. Yeah. Because that's where everyone will get buggered up.
Everything in this, if they say you get a 10% return, you have to think that, wow, I've got to take some genuine risk there. Now, Roger, we're going to start the speed round for you.
Oh, so very good.
We'll have to leave it here, but before we do that, we're going to have a speed round, and we're going to start with Roger. The speed round is the Speaker's Corner. Roger will be on 6, and he'll be talking as of now.
So what I'd like to talk about is the Australian dollar. With the AAA rating, high material and resource exports, and very good credit rating, high interest rates, we've seen the Australian dollar very strong. But what's happening now is we're seeing a deterioration in competition. Our manufacturing is now dying. It's fallen by 40% of the economy and 20% in the last 2 years. And I think if the RBA doesn't do something to lower the Australian dollar, we're all in very big trouble.
Well done. Welcome back to the program. We're on our last segment for the night, so we've had a great deal of fun and some really good questions. So please feel free to give us another call on 1300 30 34 or email us. The email is yourmoney@skynews.com.au. Now, we've missed out on your Speaker's Corner, so we will be talking to you soon. But what we want to do is we start with Roger in terms of the Aussie. What was your thoughts on that in terms of the effect of the Aussie? It's quite significant at the moment, isn't it?
It is, yeah. Well, the Aussies, whilst it's come off a little bit in the last 10 days or so, I mean, reality is, you know, we're still at levels 102, 103, well over par. And I think it's pretty well documented that certain segments of our industry, you know, be it education, tourism.
Tourism's buggered, you know, tourism stuffed. We've got a problem in retailing in Australia. You've seen some big names, Darryl Lee, you've seen Allen's Music, you've seen the demise of some iconic brands in Australia. And this is all because the Australian dollar's been so persistently strong. Now, what's interesting is 3 weeks ago the IMF came out and they said we're going to start individually reporting Australian dollar and Canadian dollar reserves, and then the Aussie dollar started to come off. And I really think the Australian dollar is now at a point where we might see the end of some industries, particularly in manufacturing in this country. We'll never see them return. So we really are in a point, and we know what's happening in resources. In the next 24 months we're going to see a lot of people out of a job in the resources sector, and what's the RBA going to do? They're going to see unemployment start to lift, and they're going to have to get that Australian dollar down.
Yeah, and I think it's through the I think it's through the interest rates. That's the only thing. They either get really radical with the interest rates, but if you're in the car sector, it would be very, very challenging to work out what the future looks like.
We know what the future looks like. The future looks like no manufacturing of cars in Australia.
Yeah, absolutely bleak.
I think it's hard, but I mean that's the practical reality is. The economy does shift, and it does move into different sectors, and I think.
Yeah, the problem is our salaries are too expensive across the board.
They've been saying
our miners get paid. Yeah, exactly. But our miners get paid more than any other mining person in the world, not just in the Asia Pacific region or whatever, or the Southern Hemisphere. Globally, our miners are paid more than anybody else. Now, no wonder Woodside's pulled out of Browse. No wonder, you know, so many of these projects are falling over, and they're falling over because the salaries that they have to pay are uncompetitive. It costs more for a business to rent commercial space in Sydney than it does for the same business to rent space in Singapore, London or New York. You know, our fuel is 71% more expensive than the United States, 41% more expensive than China. We're not competitive.
Now, we missed you on Speaker's Corner, which I really love, my little segment on Speaker's Corner where you get the chance to have your own speaker box. And so we'd like to go to Steve. So Steve, if you can look at your microphone, your camera, your time will start now.
Okay, well, guess what I'd like to talk about is just the growth in corporate bonds. This show is largely been about that, and Mark's been spearheading that for a while now. But the reality is we think in most people's individual portfolios should think about corporate bonds, should really think around need for stability of returns, and I think is that you'll see more and more opportunities, I think, over the next few years as this becomes a part of most people's normal portfolios.
I couldn't agree more. I understand all the stories about equities, and I think one of the things with the equity market, they need to appreciate that the bond market isn't saying don't buy equities. No. The bond market is saying that half a basis point of everyone's superannuation fund has a fixed income component. It might get to 1%, but it probably isn't. And globally, we are so underperforming. And I understand everything that you've just said about the economies of Australia being very expensive. One thing we are absolutely belting on is our superannuation industry. It is what a great performer. I hear the politicians talk about the tax, blah blah blah. They all want the money, but that thing has to be right. And if you rely on people solely getting the equity market right, that's a problem. And I feel that you need to understand the education has to continue on with what the fixed income piece is, and it stops all that volatility. And I suppose that's my 30-second soundbite. I suppose nice. That's well what we're going to wrap it on. It's been great to have you guys on. It's been a great show. We'll have to do that again. It's a
thanks
nice
for inviting me again after I stood you up last time.
Could you imagine that? It was a very interesting Saturday morning when we were talking on the phone and say, how was your day? Because mine was quite challenging. We spoke for an hour. But for Roger Montgomery, I'd like to thank you from Montgomery Fund for coming on board. Steve, great to have you on, Executive General Manager of the NAB. They don't get much higher than that, so that's fantastic.
Thank you.
We didn't get a chance to talk about those debt markets. All the best. Enjoy your Friday.
Thank you, Mark.
Thanks, Mark.
Has endangered the first time a marine
program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.